Hello, everyone. This is Seth Groff. We're going to begin here in just a few minutes, so sit tight, and the presentation will begin here shortly. Thanks, everyone, for joining early. We'll be ready to kick it off, like I said, just in a few minutes. All right. Well, hello, everybody, and welcome to today's webinar, Advanced Sales Techniques Selling Disability Insurance to High Income Professionals. I'm your host, Seth Groff, and I'm joined today with Ryan Lobo, DI Expert. Ryan, how are things in New York?
Good, getting chilly. Not as much snow, I think, as a lot of the other country has experienced, but we're hanging in there.
Yep, we got some white stuff on the ground here in Nebraska and enjoying these cooler days. But in addition to the weather across the United States, we're going to talk about selling disability insurance to high income professionals. And, when I look at any sales opportunity in the insurance world, I'm looking for three things, right? Number one, do they need it? Number two, do they want it? And number three, can they afford it? And when you talk about high income professionals and disability insurance, they usually check all three boxes. Now, I am going to give a little spoiler alert here. We talk about advanced sales techniques, but really high income professionals have the same needs as even, someone maybe making 100,000 of income. And so if they rely on their income to maintain their lifestyle, then there's going to be a need for disability insurance. And I know that sometimes when you get into super wealthy people, you kind of ask the question, are they working because they have to, or are they working because they want to? And if the question is, they got enough assets, they're just working because they enjoy doing it. Well, guess what? You know what? Maybe it still makes sense to purchase disability insurance and put that risk on the insurance company instead of carrying that burden as well. So we're going to take a look at a lot of great ideas today. We're going to look at the concerns of high income clients and identify some risk that they have that other individuals might not. We're going to talk about sports and entertainers. I get a lot of phone calls. I'm surprised of, how many buddies of Taylor Swift's cousins I talk to that have an opportunity to sell, insurance. But no, these opportunities do come up. And, with everything going on in sports, especially in college athletics, there's definitely an opportunity for disability insurance there as well. One of my favorite is we're going to talk about the self-insurance objection, right? I have enough assets. I don't really need insurance. And I'll give you a strategy to overcome that. We're going to talk about our risk rated product versus the Lloyd's, when one makes sense for high income individuals and when the other makes sense. And then another one of my favorite topics is just share some, tips for networking, prospecting, and, how do you get in front of some of these higher income individuals out in the marketplace. So before we start, just to kind of get your mind thinking of where we can help. Remember, we have two companies that Ryan and I represent, Risk Insurance and Reinsurance, which has a graded product. Okay. So for anybody that's with incomes up all the way up to $500,000, and if they're not able to get individual DI with a traditional carrier due to a pre-existing health condition, Risk is going to be able to help that solution. And then we also have IDU. And so IDU is what is considered a Lloyd's cover holder. What that means is that we market, we underwrite, and we administer policies issued through the Lloyd's of London market. And that's going to come into play for excess coverage. We're going to take a look at, participation limits and what you can do when an individual has needs above participation limits that your traditional DI carriers put in place. We'll also look at business solutions, buy, sell, key person. A lot of times these high income individuals not only have a need for individual DI, but if they're a business owner, there's probably an opportunity for some business sales as well. And then, as I mentioned, also we'll take a look at sports and entertainment markets because we do get a lot of questions on those as well. So let's kick it off with the first topic and the biggest opportunity that I see out in the marketplace that anyone can, go out and look for is going to be high income individuals. So, what happens is that domestic carriers have what's called participation limits. And right here, this is a chart out of Milliman's annual survey of the individual disability insurance market. You can go out, you can Google this report and, look at this chart itself. But this is the participation limits out in the individual traditional DI marketplace. And what that means is that carriers won't issue more individual DI once they hit that limit, right? So, you have, 25,000 with principal. Standard's only going to issue another 10,000 to get up to that 35,000 amount, even if your income justifies amounts over that. So where comes into play is going to be excess coverage through the Lloyd's of London market. And so if you do the math on this, you come back and you say, okay, well then it's only going to be, incomes over 700,000, right? Because that would get you up to the 35,000 participation limit. And that's not necessarily true. Remember, this is their top
Mhm.
non-medical occupation classes. So a lot of times, your lower occ classes, your blue collar, your gray collars, aren't going to be able to get that maximum participation limits. And so I always say, once you're starting to talk with someone that's kind of over that 250,000 income, you might have an opportunity to start looking for excess coverage. Okay. So it just depends. But that's where we can kind of come in and coach you through and saying, yeah, there is an opportunity for excess, or no, actually maybe go back to the traditional market and get some more individual DI through a traditional carrier. That's kind of where we can come in and provide some additional value. But I just, as a rule of thumb, I would say, once they hit kind of that 250,000, there might be an opportunity for excess coverage. So
Nathan,
let's take a look at,
I just jump in here really
yeah,
quick and say, obviously, that's, based on occupation, right? As you
yep,
mentioned, for example, we see healthy chiropractors all the time who
yep,
the traditional market is limiting them to 8,000 max.
yeah, great
So
example.
even when they're making less than 250,000, there's a need for that excess. And with that being said, there's always an opportunity where we say max out on the traditional market. Lloyd's and our FSL products, we're not meant to compete. We're meant to fill in the gaps where those traditional carriers aren't being able to meet the needs of that client, right?
Yep. Yep, absolutely. No, chiropractor is a good example. So, you know, always just look at how much, and if they need more DI, let's start having the conversation and seeing what we can do. Here's a pretty standard opportunity that's out in the marketplace. It's an individual that has group long-term DI. We're going to talk about the pitfalls of the group. They also have an individual DI product, okay, that they obtained from the traditional market. And then we were able to come in with IDU and sit on top of that to get to protect more of their income. So you can see that, just with the group and the individual DI, he was only protecting 35% of his income. And I bet he was living on more than 35% of his income. And so there's obviously a big gap there. And going out there and having this conversation about the excess coverage is probably going to resonate with him. And so we were able to do a $40,000 benefit, 90-day elimination period, 5-year benefit, and protect him with 2.4 million of additional DI coverage. So pretty significant there. But this is the conversation that you need to be having. And we talk about group coverage. And group coverage is not enough. And you should be having this with this conversation with the people making 1.2 million and the people, making 100,000. There's an opportunity here for all of that. Because remember, with the group DI, right, it doesn't cover high incomes employees' entire salary, right? So this 10,000 a month is 120,000. If you do 60% of that, it's only covering people up to 200,000. Anybody over 200,000, you know, definitely needs more DI. A lot of times your group DI doesn't cover bonuses, right? And so especially like, um, you know, insurance companies, for example, right? There's going to be employees that have bonuses tied to sales. That group DI doesn't cover those bonuses traditionally. Also, the benefits are taxable, right? And so individual DI, if you buy an individual DI policy, benefits are usually not taxable, but group disability provided through their carrier is probably going to be taxable. And so what that means is that now they're going to receive that benefit and be taxed. So they're only getting 60% of their income and they're going to be taxed, right? Where on an individual plan, it's going to be tax free. The group plans have limited definition and benefits, and then again, participation typically limited to 60%. So anybody that you're meeting with, and again, this is for your high income people in that company, but everybody in this, you need to be, educating them that group DI insurance is not enough because there's a tremendous opportunity there. And so in that particular group of that individual, here are kind of the opportunities. I'm going to start at the bottom, individual DI for everyone, right? And again, we're not solving that, well, unless they have an impaired risk condition. But I always tell you, Northwestern Mutual agents are the best at this. They go out there, and anybody that says they have group DI, they show them where they can fill that gap on that and get them up to a higher participation limit. And so you should be having that conversation with everyone about that additional DI coverage. But anyone earning more than 200,000, you should be going out there and having a conversation with them about individual DI. Again, that's probably might be a better solution with a traditional DI carrier. If they're earning over 500,000, because in this example, the individual DI was up to 15,000, that's where we would come in and play in an excess. But then also risk our impaired product could be that individual DI solution for anyone with pre-existing condition. And so, we would be able to get them that higher participation limit on the individual side if they do have those pre-existing health conditions. So in that particular group, there's a lot of different opportunities, and there's a lot of areas where we would be able to come in and solve those specific needs. So
Yeah, and so I would just pause for a second
yeah,
and say, FSL, obviously, that product, we're domestic filed. We are not traditional because we do the impaired market in that, definition space, but we don't have the same participation limits that other carriers do.
yep,
Correct.
yep, yep.
So even if they are maxed out with 30,000, if they are eligible for an additional 25,000, we're able to do that with FSL as well, and you're locking them in with that guaranteed renewable to age 67 product.
Yep, absolutely. And this is an example for that group that we just showed. Again, it varies depending on their group DI, the individual plans that are going in there. And so just keep this in mind. These numbers are flexible. These are just for that particular group that I just showed. But I'll get off my soapbox. I always think that the group insurance and going out and the excess is the greatest opportunity to sell to high income professionals, but I know the ones that get a lot of the interest are going to be entertainers and sports. So, Ryan, before I have you talk about opportunity with entertainers, I have to tell you my Miley Cyrus story. Okay.
Okay, I'm
So
dying to hear
this
that.
was several years ago, probably maybe probably 12, 10 to 15 years ago. I'm running meetings in California, and we're meeting these insurance agents at a sushi restaurant in off of Sunset Boulevard. And there's this real fancy, or this real popular sushi restaurant that we got reservations for, and there's no parking. You only can valet, right? So we pull in our crummy rental vehicle, some cheap SUV to valet park. And this was right around the time where with the remote keys, okay, so remote keys were, and my coworker Jan was driving, and we get up there and she can't find her keys, okay, and this blacked out SUV pulls up wanting to park but can't get into that one little spot. And then all of a sudden they kind of peel out, and we see them pull back up around. They like went around the block or something while we found the keys. They pull up, and it's Miley Cyrus and what was her boyfriend's name? Shyla. Uh, get out of the car, and then they're like sitting like three tables away from us at this sushi restaurant. So we prevented Miley Cyrus from valet parking is my entertainer story. So,
Did you
anyways,
sell her disability insurance?
I did not. I play it cool. I play it cool. I didn't, didn't even say hello. So,
Oh, that's a really good story. That's hilarious. And I'm sure she remembers you and still curses your name to this day.
yep.
Curse them. Anyway, yeah, so I think it's interesting because, Lloyd's of London, if anyone does recognize the name, whether they're in insurance or not, typically it's kind of that sparkly sports, entertainers, oh, J-Lo's butt or so and so's legs or hair, so on and so forth. And what's always so funny is I do actually regularly, I've been doing this for over 10 years now, still get requests and inquiries about body part insurance, especially and specifically to entertainers. And there might be a case for that. I would say the market has moved very far away from body part insurance, because the true nature of the risk is if you're a pianist and you need to use your hands, you can insure your hands. But what if you break your back? What if you become a paraplegic? What if you have brain cancer? Right? Even though your hands are perfectly fine, you're not able to use them in that occupation. So really, it's a more holistic look of the entire risk because, clients and especially clients in this market tend to be very focused on what their moneymaker is. But with that being said, they're not thinking of all of the other factors and all of the other areas of your body and the other things that can happen for a disability that would still affect their earnings, right? So I think it's very easy for people when we're talking about Lloyd's and entertainment to go to this very niche, very glitzy idea of coverage. But at the end of the day, what you're looking to do is cover their income. And how are they going to continue to earn that income, right? For entertainers, there's definitely a nuance in their income and the way that they earn that income. They could be making residuals. They could have some more high risk or travel aspects, where I would say as a broad swath, they're not going to be considered by any kind of traditional carrier. So in this case, you're not talking about layering on top of any existing coverage. You're talking about starting from $1. So we have products that do, cover their income for their own personal income protection needs. You might be talking to a studio or a marketing company that has launched a campaign specific to that individual where they might need key person disability insurance. Maybe they are traveling or doing, kind of out of the box stuff, accidental death. And event cancellation, we see that in the music space a lot. And event cancellation can mean a lot of different things. That could look like, is it weather related? Is it that the non-appearance wise, the musician didn't show up to the gig, so on and so forth. So event cancellation is a broad umbrella term. And as you're farming these kind of opportunities and seeing these kind of opportunities, there is a ton of different nuanced products. And that's where we come in as your experts, where you're talking to these individuals or you're talking to these businesses, you're talking to these companies, you have opportunities here. You can bring us, hey, this is some of their concerns. This is where they're worried about a loss. And then we can help guide you through different products and different solutions that might fit those the best, right? So that's all of your very like niche, nuanced, different product stuff. I think a very important product to talk about also is not only the key person, not only the personal income, but it's also the contract protection insurance, because this is a very, very unique product specific to Lloyd's. So we have the CPI. There's also another product. They're in essence very similar, which is a critical asset protection. Essentially, it is a life insurance product where it is covering for death any cause with very minimal or no medical underwriting. So this is the situation where a studio has a contract for an actor for a series of movies. I think Spartacus is a very good example. They had their first season, the actor died, but they had multiple seasons lined up, and then they had to go and replace that actor and scramble to solve that need. So they're going to be out on a loss of, what do we do now? Maybe the series isn't as successful. We need to pay a new person. We need to go hunt and all the lawyer, like all of the things that get wrapped up in that kind of need. You're not going to find usually a very solid life insurance option. And these policies are typically shorter term. They're about 1, maybe 3 year in length of a policy term. But what they're doing is they're serving an immediate need and they're serving a very unique niche need in that death benefit life insurance space. So it's good to keep in mind that we have a whole range of solutions for all of the very unique aspects around the entertainment space. So we see a lot of actors, directors, producers, certainly a lot of musicians as well. I would say that also, your promoters, your venues, social media influencers fall into this category. And it's actually interesting, Seth, as you were talking about the bonuses income wise, I was thinking of a client where they were a dentist and that's what they, made their base income on. But they also had a YouTube or a TikTok or something like that as a dentist where they were doing different dental health kind of awareness stuff and they were making a good amount of money off of that TikTok. They're now a social media influencer. So even though baseline wise they're a dentist and they might have that income pretty protected from a traditional standpoint, they also have this other source of income that isn't being protected. And so social media has really added a whole new layer of how people are making their money. And maybe they're doing dual occupations or more than one occupation in that space. And there's an opportunity to get them insurance for that specific thing that they're doing outside of their regular occupation. So again, another interesting twist on when you're talking to clients. Maybe they are making their regular income, but do they have other income sources? Do they have other ways that they're, earning that buck and need to protect that?
Yeah. No, there's a lot of opportunity there,
Mhm.
and the whole influencer market is always intriguing. Everybody kind of, especially old people like me, don't take it serious, but there's some people making some serious
Oh, God,
money out
yeah.
there, and have a need for these products. So a
Mhm.
lot of opportunities there. So
Yeah.
Before we jump into the sports opportunities, I got a trivia for you, Ryan. All right, can you
Okay.
name the top three athletes to come out of Chadron State College? So Chadron State College, college in Western Nebraska, Division II school. Can you name the three most famous athletes to come out of there?
The Nebraska boy throwing me a curveball. I absolutely 100% cannot, Seth.
Okay, so Don Beebe played for the Buffalo Bills in the 80s. He was a receiver, number five, played for the
Mhm.
Buffalo Bills. He went to Chadron State. Danny Woodhead, he played for the New England Patriots and some other teams, and he actually scored a touchdown in the Super Bowl. Now, the interesting thing about Danny Woodhead was he was really short, and all the D1 schools passed on him, but Shadron picked him up, and he had a successful career in both D2 and then also and then for the Patriots and some other schools. So those are the top two, Don Beebe and Dan Woodhead, and then
I'm gonna notes.
then Seth Groff. You probably can't see this, but all the way down here at number 21, still 20 ranked 21 for all-time win record at Chadron State College. So all jokes aside, I probably wasn't getting it, or I obviously wasn't getting NIL money or would have, but I always joke that I'm the third famous, which obviously isn't true. But
I
talk
actually
to me
see that
about
coming.
opportunities in the sports markets.
Yeah. Oh my God, I'm blown away. I'm in awe, actually. We are all in the presence of a really serious athlete over here. All right, Seth, I see you. Okay, so sports wise, and I would add that, sports is just like entertainment. It gets a lot of oohs and ahs, right? People want to throw their hat in the ring on sports. It is a very competitive market because there is such limits, around how many clients you have, how many different syndicates in the Lloyd's market are going to be able to do that and participate in this area because, of course, naturally speaking, when you're talking to an athlete, right, there's a lot more risk involved with injury where something like a torn ACL isn't really going to stop your attorney for a very long. It is going to highly affect your athletes, right? So, more minimal injuries, more disabilities associated with those kind of impacts are going to mean a lot more to their career and to their earning potentials. So in this area, we have again a lot of different products. Your standard draft protection, which is obviously going to come into play when you're talking to a lot of these college athletes. And a lot of colleges have actual programs set up direct with different cover holders and specialty risk underwriters for disability insurance. However, they're uniquely vulnerable when they're negotiating a draft protection contract. Right? If they're projected to make $30 million dollars and something happens in those last few months of their season, and now they're not signing or they're signing far below that, they're super at risk to have that loss. That's millions of dollars of loss. So you're talking about draft protection, you're talking about future contract value, which is often referred to as loss of value. These products are really specific to the time frame of that player and how they're negotiating that contract. Are they about to be in free agency and negotiating their next one? And they're really designed for those top level players, right? Draft protection, typically the top five draft picks. As you move down that scale, the interest of participants as an underwriting, sign off is going to reduce. So you're really only talking about very top tier players because they are projected to make a lot more money. But there's still a lot of opportunity for a whole range of these athletes in these different sports. So we see a ton of hockey. I think that's our number one athlete niche. And every different athlete has very unique needs in that they have different contracts or they don't have contracts at all. So hockey players, typically they have guaranteed money if they get injured while they're playing hockey. So we have products that do off ice, on ice, or 24/7, where you wouldn't have that applied to a football player because their contracts work different. So the nuance in how that individual's contract works and how they earn that money is very, very, very important when you're talking about athletes and sports coverage, especially in regards to disability insurance. We love coaches, broadcasters, referees. We write these all day long. We can go up to the 65%. You're looking at a more standard kind of personal income hat, so to speak, when you're talking to non-athletes that are still in the sports arena. And we see a lot of referees that do have more normal, like daytime 9 to 5 jobs, but are also earning quite a good amount of money and still working full time as a referee. And these can be seasonal. They can, span a whole range of income levels and how much they're doing. Some people are just full-time referees. I would say on average, we quote throughout the year over 100 of these individuals, because again, they're not going to have any options in a more traditional DI marketplace. So I don't want people to limit or to hone in on just athletes when it comes to sports and the opportunities for disability sales in this space. But going back more to our athletes here, because it is definitely more niche, their typical policy terms are going to be 1 to 3 years. We have, as we list under the types of coverage, temporary total disability, which is a monthly benefit structure. We also have that permanent total disability, which is a lump sum benefit structure. And you're going to see more lump sum benefit structures for your NBA players, your NFL players, these individuals who are negotiating contract deals, who a serious injury that prevents them from ever being able to play the sport again has a very, very high loss for them. There's also things like critical injury, where maybe they have blown out their knee, but they're going to go recover. However, there's still a loss. They've still now had to take time off from the season, or now they're not projected at the highest level where they have the best contract negotiation abilities. So critical illness comes into play for them a lot. You're going to see the monthly benefit structures more for your golf, your tennis, these individuals who are making their income not from a team contract, but from winning a Wimbledon or a PGA type tour, where if they're no longer able to do that, now they're out that earning. So there's a huge range here again, and this is where our expertise comes into play. If you're looking at athletes that have contracts like your NBA and your NFL typical, you're going to be looking at more of a lump sum, a 1 to 3 year term. If you're talking to referees, you're thinking of more of a personal income. Let's do a 65% replacement ratio. Is a standard 5-year policy term. If you're looking at your extreme sports, those are definitely going to be more difficult. So some of the more unique, I actually this year worked on, this actually probably covers entertainment and sports, a pro wrestler who was also a social media influencer. And it is very difficult to do any, Lloyd's broadly doesn't love boxing, doesn't love wrestling, doesn't love all of those physical fighting for the nature of the risk, there is still potential opportunities to get coverage. It just depends on who they are, how much they're making, what they're doing, right? These are all very, very, very important questions when you're looking at these risks. So this individual, we actually pivoted more to covering his social media influencer income, because it was very difficult to look at his WWE type wrestling, stunt type performance. So sometimes there is a way to pivot and get creative on how are we helping that client solve the risk of disability and protect their income, even if it's not exactly as they thought it would be to begin with, as a WWE wrestler, for example. So again, there are a ton of creative, I mean, this is the thing I love about Lloyd's the most, is there's a ton of creative workarounds. It is also a double-edged sword because, there's so many answers and it's always gray area. But we're here to walk you through that and provide the answers for you. And it's always worth the question. I would add, it's always worth the question of, hey, I have this opportunity. What can we possibly do here?
100%. I tell people all the time, you are not going to bother us by asking, and
Yeah.
we're going to look and see how creative we can get to making an offer. So let's pivot real quick. Ryan, all great stuff. I do want to hit on the business products as well briefly. So high level, we're going to talk about buy, sell, and key person. But being conscious of time, just let's talk us through the opportunity with key person and
Yeah.
then buy, sell.
Yeah. Well, a not secret of mine is that Key Person is my favorite product. I say that all the time, because of the flexibility. This product answers a whole host of different business needs because the benefits can be used however they see fit. Once the benefit is paid out, once a claim is filed, it can be for recovery of losses. It could be for new hire expenses, severance expenses, you name it. But business overhead. I mean, a lot of the other business products are specific to a business loss, overhead, buy, sell, loan, so on and so forth, where a key person could essentially blanket and be used however they need. If they need to pay off a little bit of a loan, they need to pay for a new hire, so on and so forth. This is a very flexible option for them. And there are products in the domestic space, so oftentimes we do layer on when that's available. But I would say more often than not, it's not available, whether that be because of their ownership percentage. So we cover key persons who have 0% ownership all the way to 100% owner of a business. They can still take out a key person coverage with Lloyd's. Maybe it is a medical or an occupational issue that's causing them a stutter step. Maybe it's how large the business is, how much benefit they need, so on and so forth. Wherever you're going to find a shortfall in the domestic space, that is where we come into play. And I have seen so many out of the box key person needs, family businesses, so on and so forth. And this does apply to buy sell, which I know we have on the next slide as well, where again, if you run up against a wall, it doesn't mean there's not an option. It means pivot to IDU to get creative to find a solution because more often than not, we are able to. Usually these benefits are structured lump sum, but in this situation, we have a monthly payout. So for monthly payouts, I would say you're talking to businesses and key person needs where they're more concerned about the immediate loss. So a lot of times these are owners who are responsible for driving the revenue. And if they weren't there after, 3 or 6 months at the business, they would have a very serious issue on their hands. So you can design that monthly benefit that is a temporary total disability that is going to help them bridge the gap. Maybe they're still able to recover and they're going to be able to return to that business. So they do only need 6, 12 months, so on and so forth, of a monthly benefit, versus they're never returning to that business, which is more of a lump sum need. But we also have the ability to do both. So here in this situation, we designed a monthly benefit so that if that individual is out for a year or two, they're covered for their really immediate needs. And then if they're not able to recover and go back to being that OBGYN, there's a lump sum on the back end to cover all of those more bigger umbrella type issues on we have to get a valuation, we have to pay lawyers, we have to sell the business, so on and so forth, all of the things that get wrapped up into losing a key individual.
All right. Hit on buy-sell agreements. I
Yeah.
see a lot of buy-sell agreements out there that have disability insurance clause, but they don't have a plan to pay for it. I guess their plan to pay for it is to scramble and find the assets. So talk to us about buy-sell disability insurance and how it can be used to fund those buy-sell agreements.
And Seth, I know that you'll feel this with me. We see agents so often sell life insurance and neglect the disability side of the risk. And there's so much opportunity. If you are talking to a client about a business life insurance policy, you absolutely need to talk to them about DI, because what's more likely during their working years? Disability.
Yeah.
Of course, death is guaranteed, but disability is the higher risk to a business, especially a business owner, regardless of the size of the company. So again, there are so much opportunity and so many agents out there are neglecting this or missing this opportunity to, once you're already talking to a client about insurance, do all of the checklist, go through all of it. You're already doing the life insurance. We use life insurance labs and medicals all the time. So now that client isn't having to go through multiple steps of underwriting to get those two policies in place. You're actually making it easier for them. And it is a much easier sale when you're already talking and have that client engaged. So I'll get off my soapbox about that. The buy sell, I did mention, again, there is a lot of opportunity, a lot of products available from a domestic carrier standpoint, but oftentimes there's either, they don't consider them, or there's not enough benefit to protect them. So we can protect either layering on top or starting from $1. I see this all the time with family-owned businesses, your medical professionals, so on and so forth. Even those occupations, again, that you might not think to talk to them about a buy-sell or a key person, that's where we come into play. And so, here we're talking about a very jumbo $90 million business, highlighting the fact that a traditional carrier wouldn't even touch it, because of the level, or wouldn't even come close to covering the exposure that they have. And that's where Lloyd's come into play, because, we are talking about 50, $100 million policies. I mean, I've seen $500,000 a month benefit quotes, right? So the dollar amount and the benefit amount is usually not something we'll ever be able to shy away from. It's all about, financially bolstering that. What I really want to highlight here is a big barrier to the sales on disability, especially for some of these business products, is the underwriting. I don't want to have my client fill out a whole application, do all the financials, do the medicals, so on and so forth. We have different programs designed to help streamline for those preferred risks. So for key person, for example, we have a streamlined key person underwriting program, which is a short form application, no medicals, a one-page financial questionnaire for your white collar individuals who are 55 years and younger. So you're making that process so much easier on the client, and they're so much more likely to proceed and purchase that policy. And with buy sell and any of our business products, we also have the ability to do a guaranteed standard issue for your multi-life. And this is for three or more individuals in the white collar space. For medical professionals, we usually cap it's five or more lives, but it is a huge differentiator when you're able to go into a medical practice, when you're able to go into a law firm and an accountant office and say, you guys have three owners, you're all responsible for buying each other out if something happens. A GSI option does an employer census enrollment and a simple employer-filled application, which is essentially just attesting that everything in the census is correct, right? Their date of birth, their income, so on and so forth. So the individual themselves isn't even filling out an application, isn't even having to go through any of the underwriting hoops that you might perceive from a disability type solution, making it again easier for them to say yes, easier for you to get these policies issued and in place.
Yep, absolutely. So now I want to shift gears a little bit and just kind of talk about overcoming the self-insure objection. This is going to be a common objection with high-income individuals. You do kind of have to question, are they really going to self-insure or are they going to go uninsured, right? Because if you think about insurance, and if I buy insurance from an insurance company, right, that company has to have those assets allocated to pay in that event of that loss, right? And so if you're going self-insured, that means that you have to have those assets allocated for that. And most people obviously aren't going to have that. But if, they say they're going to self-insure, I like to play along. And it's real easy now to show them the amount of money that it would take to self-insure. So I have an example here. It was a 600, it was a case, it was $10,000 a month, 5-year benefit. And so that total benefit was 600,000. This individual had a heart attack, right? And so we were talking to him about Flex DI, and it was $375 a month. Okay. And that seemed too much, right? He was just going to self-insure. Well, if I had a crystal ball and I could say, listen, you're not going to get disabled for the next 10 years. So if I knew that, okay, which we don't, right? We don't know if you're going to become disabled or not. But if I had a crystal ball and said, you're not going to be disabled for the next 10 years, you would have to invest $2,930 a month for 10 years, assuming a 10% interest, and that's what you'd have to invest to get to 600,000, right? Now all of a sudden that $375 a month doesn't seem like it's that much. And also, you don't have to have a finance degree to figure out that calculation. All you have to do is type it into Chat GPT and it gives it to you in a matter of seconds, right? I took all the finances classes back in my days at Shadron, and I had that calculator and could do all of it. Literally takes seconds to figure that out for that particular one. So they're not going to right. They're not going to give you $2,930 to self insure, and even if they would be better off getting the insurance, investing the difference, which is 2,555 at 10%, and then after 10 years, you'd have $523,000 and the insurance. So if you got disabled, you'd get the 600,000 from the policy, and then you'd also have the 523,000. So, self-insurance, throw it out, because what it boils down to is they're usually going to go uninsured, right? And then you need to have the conversation about what assets do you have available that you would use to replace this, right? And most of the people, when they start looking at their accounts, they're going to have to go to retirement. And then the question is, if you're using all your retirement account while you're supposed to be working due to a disability, what are you going to use in retirement, right? And so, that's kind of how I like to overcome the self-insure objection. But I also will say, from an industry standpoint, that we shouldn't be using that self-insure term, we should be using going uninsured because really in reality that's what people are doing. They're not
Right.
self-insuring.
Right.
Self-insuring is I have the assets to pay for it, and that's not what's happening. So that's a little bit of overcoming that. Now, Ryan, I know you've already done a good job of kind of explaining where we fit. Remember, with IDU and the Lloyd's marketplace, we don't compete with the domestic market. We are going to do the things that they can't. And so we already
Mhm.
talked about high limits. We talked about business plans. We can also do medical impairments. We accept occupations they can't. And then, it's really easy to lay on top of existing coverage as well. So keep that in mind from an IDU standpoint of where we are going to fit.
Mhm.
On the impaired front, I'm just going to say, again, this would be your individual DI for individuals that can't or is having difficulties getting coverage with traditional carriers. I'm very passionate that for that first layer of individual DI coverage, Flex DI is a better solution. The
Mhm.
reason for that is that when we look at the Lloyd's policies and the difference between the Lloyd's policies is that they are on a limited term, right? Anywhere from 1 to 5 years. That means they have to go through underwriting every 1 to 5 years. Now, in a lot of those markets, that's the only option. And so that's a good place to go. But speaking specifically to those high income individuals that need that first layer of DI coverage, I think that the risk Flex DI is a better solution because it's guaranteed renewable. So they only have to go through underwriting once. All of our products typically are issued without medical exams, so we make it really easy. But those level premiums in the impaired market space, I just think makes a lot of sense. And
And
always the biggest objection that we get in the impaired market for that is cost. And you can see there at the bottom what the Flex would cost because it's guaranteed renewable versus the Lloyd's. But what I always tell people is look at the length of the contract, right? Because every 5 years that price is going up. And we don't know what that's going to be because the Lloyd's market changes. But
mhm.
if you use today's rates at that age, on a 40-year-old in this example, you actually end up paying more over the lifetime than going with the Flex product. So
Yeah,
uh,
and so I know I'm a big Lloyd's nerd, and I can go on and on and on, but I really actually see how much that FSL product. I mean, we don't say this enough, where rarely are we excluding for pre-existing conditions,
yep,
diabetes being one of the biggest ones. I see this as a broad exclusion when you're talking to a Lloyd's cover holder. If you have a attorney who is young in their career and maybe they are making 200, so on and so forth, but project that through the lifetime of their career and earnings and how much that'll go to, and they don't have an exclusion for diabetes, they have type 1, for example, so they're never going to get a traditional DI option. Why you would not put a flex DI like policy in place for them that's covering them to age 67? I don't even, there's no answer for that. You should.
and that's one of the value that we bring. There's no other organization out here that
Hmm.
has the modify or the graded, impaired product and the Lloyd's. And so we
Hmm.
come at it with an unbiased opinion, right? If you go to any other Lloyd's cover, they're going to say, no, this is the best solution. Where we come at it unbiased. We got both solutions. We're going to say this one's better in this scenario. This one's better in this scenario. And
And you can purchase both.
or both. Good, yeah, good example. A lot of times we do see both, and again, we can streamline that underwriting because we're using the same information. So
Yep.
that's how the premiums would look on that one I just went where with FSL to age 65 was only actually 103. Making assumptions with the Lloyds, you can see they actually end up paying more with the price increases every 5 years. But again, this is hypothetical. We don't know what the prices in the Lloyd's markets is going to be. So my hot take, and then we'll wrap this up. But again, with high income individuals, I'm a firm believer risks. Flex DI is the best solution. Get that base coverage. If they need more coverage, stack IDU on it. But impaired, look at risk. It's a better product, and where the value's there with the cost. IDU going to be great for excess. It's going to be great for business solutions and then sports and entertainers. But as Ryan highlighted, sometimes Flex might actually be a better solution if they want a more permanent product where they don't have to go through underwriting every 1 to 5 years on a Lloyd's policy. So prospecting, just real quick, I always talk about millionaires next door. I live here in Nebraska, south of Omaha, about 30, 40 minutes. And, you can go around my entire block and there are people here with that need for excess coverage. Right across the street, our good friends, Bridget, she has a therapist office and she does very well. Doctors live a couple houses down. I go over there and I think if I get enough bush lights in them, I might be able to get them to sign up for an IDU policy. So the point is these people are all around, business owners and just high income individuals. Everybody's going for the top, right? But they're all over, and so you just have to act professional, and you might secure that. Centers of influence, obviously, this is where everybody kind of goes. I'm just gonna, spoiler alert, they're not going to refer you their top income clients, right? They're not going to risk losing them because of you. So usually with centers of influence, you have to refer them clients first, and then saying, hey, this is my client, this is what we did for them, and then they're like, oh, you did this, and then referred them to me. They're going to be more likely to do that. So that one, always gets a lot of attention, but you're going to have to provide some value there and really show your expertise in this market before they're going to, refer them to you. Then the last couple, hang out where they hang out and buy all the muffins. I've actually got these from Jesse Eitzler. He's an entrepreneur. I don't know. He used to own a jet company, but when he was trying to find clients for his private jet company, he said he was broke, but he knew that all the, high income business professionals would go eat lunch at this restaurant at the Ritz-Carlton. And that he would go there, order a water and a salad, and they would give him a table. And he would just sit there all through lunch eating that salad, and they'd never kick him out, right? And just through time, he would eventually meet these high income people and was able to get them, to join his private jet company. And so, his message is like, you got to hang out where they hang out and, interact with them. And, he, like I said, he was starting this company, but that worked for him. Another one of his that I like is he calls it buy all the muffins. So he went to some conference where all these high net worth people were that he wanted to meet. And the first day he was sitting there, there's a coffee shop, right? Probably, I don't know, it might have been Starbucks or whatever it was, but he noticed that, people would come down and order a coffee and a muffin. And so the next day he just went in there and said, how many muffins do you have? And they said, whatever, 50 muffins. He's like, I'll take them all. So he bought all the muffins. And then and then when people would come in, they'd say, I'll take coffee and a muffin. They say, sorry, we don't have any. And then he'd be like, when they walk away, he'd be, hey, sorry, I heard, that you ordered a muffin. I actually bought two. You can have this one. And so that's how he started conversations as well. A third one that I like of his is, again, he was broke, but the Yankee tickets, like season Yankee tickets, like on the right behind third base or first base came up, and like all the money they had, it took. But getting those tickets and giving them away to high income professionals, right? Got him a lot of business there too as well. So high income individuals, you don't have to like overthink it. Again, the millionaires next door, they're out there. But Jesse Eitzler, I love his prospecting ideas that he shares that work for him when he was trying to get clients for his private jet.
You gotta love a sales. You gotta love a salesperson, right?
Yeah, you got to be creative. So uh,
Creative.
with that, Ryan, any concluding thoughts for the audience today?
Um, Other than I would say IDU, and as you mentioned, we're uniquely positioned because of our ability to offer so many different products, both from the FSL traditional domestic filed to age 67 product sphere and from the Lloyd sphere. So when you're coming to us for solutions, You're not just getting a Lloyd solution. You're not just getting an FSL solution. You're actually able to furnish your client with so many different options. And our creativity and flexibility around underwriting, making that easier on the client, on the agent to make that sale, because that is so important when it comes to DI. Again, not requiring medical exams, having different options that are streamlining that that program, is, I think, one of our biggest differentiators.
Absolutely. And the biggest thing is, again, don't be afraid to ask. If you can't find a solution, if there's a specific need, we just try to share some ideas to, keep an open mind out there, but don't be afraid to ask. We're happy to take a look and we try to get creative whenever we can. So thanks everyone for joining us today. Hopefully
Thank
you can
you.
find some high income individuals before the end of the year and look forward to talking to all of you in the future. Thanks everyone.
Thanks.